There you go. Take back the screen. Yeah.
So a couple of things that we could look at when we look at the um, option trades. Uh, we could analyze it from a lot of different perspectives. Um, so from the top part, we could look at the trading volume and break down that trading volume, but we could also look at, well, how were the option values impacted by the trading, right? So it's not just the trading volume, but what about the values? How are they impacted? So we could look at a stock, and it's very easy to look at a stock and say, well, there's a lot of volume, like here in SPY. If there's a lot of volume, we could compare that volume to historicals. And how was the stock impacted? Well, it was up almost a 0.5%, or here in the pre-market, it's up a 0.5%. So now we know the volume and how the stock was impacted, which indicates, right, it was more bullish than bearish volume, that there was more demand for the stock. Well, in options, we could have a lot of volume, but there are lots of different options. And it's also, how do we measure how the values were impacted? Because you have prices of the options, but then you also have this implied volatility or relative value. So, the price of the option could get impacted by there's various factors that could impact the price of the option. You could have a delta because the stock's moving. You could have the implied volatility. You could have the theta, and then how do we benchmark them? How do we measure it? So that all becomes important too, because you want to know that information. What the trading and the order flow, how's it impacting those values? So I'm going to slide down here, and we kind of discussed this visually, graphically. We saw in this graph where the volume is concentrated. That's where these bars were. The yellow ones were calls stacked with puts. And we saw them visually, how they compared by expirations. These are different expirations available to trade. And then we looked at these line charts, which were showing us the at the money implied volatility. And another chart shown the same strike the day before, so we could see how the implied volatility changed. Okay. So I'm going to come down here, and we're going to now look at this table. And in this table, we have the list over here on the left-hand side of all the expirations that are listed and available to trade in SPY. So you could tab through it. You could see there's lots of different expirations in SPY. It's one of the busiest or most active uh, securities for options trading. And then we have the related statistics for that expiration going to the right. Okay. And this column over here, this just shows us the events. If we detect any kind of upcoming events that may be meaningful, usually it's like in earnings, but SPY doesn't have an earnings or company conference call. So SPY, it's an ETF. It doesn't really have, there's always market events. So if there was a big event coming up, we would put it there, like maybe like an interest rate decision. Next to it, we see that at the money implied volatility. Okay. So this just visually lets us see it. And we could actually, let me just drop this down to see all the expirations. So we could come, now we could just slide down to see all these expirations. And this just lets us eyeball to see what the implied volatility is, that the money implied vol for each expiration. And you could just scan with your eyes and see that it's basically moving higher as we go out further in time, which, even here graphically shows us the same thing. And then we get into how the options are set up, right? How do these options look relative to each other, and how they might be impacted. So now that we saw how the at the money IVs look, which is basically an upward sloping term structure. What about within the expiration? Right? How do they look, the options relative to each other, if we look within the same expiration? So let's just go out, this one already expired October 16th. This one's a 1 day, but let's just go maybe to October 18th. So October 18th, you can see if I slide all the way to the end, the last column just gives us an idea how many days are left to expiration. So, well, it just tells us how many. So you could see here, this has 2 days, 3 days left. How many days for this expiration until those options, mature and expire. So if we look at October 18th, without going through and analyzing each option, we need to get some kind of benchmarks, an idea. Well, how does the skew look like within the expiration? And the skew is what the options look like relative to each other as you move along the different strikes, because options have different strikes available to trade, and not all of them have the same implied volatility. So if they all had the same implied volatility, then there would be no skew. Basically, let's say if at the money in October 18th was 10.1, well, if all the strikes were 10.1, right? Let me see if I click on it, if it makes it available, shows us. But if all the strikes were 10.1, there would be no skew. But what if they're not all 10.1? What if some are higher than that at the money, some are lower? What does that look like? Because that gives us information of how the trading and the markets are pricing these options. So when I clicked on it, let me actually go back to 10. So when I clicked on it, we got this graph over here, but we also see here in this table really quickly 2 numbers that we could reference. One we're looking at is if we have this at the money, right? And if we have it at the money and we say, okay, let's run this test. Here's that at the money strike. Let's say it's whatever, it was like 582, right? We have this at the money strike, 10.1. If we put 10.1 for every strike available, let's just say we did that. Every strike we put 10.1, and then we compared it to the actual value, right? What our 10.1 benchmark versus the actual values of the options. And then we looked at the 25 delta put. So what we did was we just normalized and said, okay, based on 10.1, where's the 25 delta put? And what is that? And what is the implied volatility of that put? And then we looked at that and compared it to that, the money, and said, how far away is it from 10.1? Okay, so if it's 10.1, then the distance would be 0 away, right? 10.1 minus 10.1 is 0. But this put shows us that the put is higher than 10.1 by 8%, 8.2%. Okay, so we have an idea that the downside, if we look at the downside from that perspective, it's skewed higher. What about going the other way, the upside? So we put same test, same measurement. We run a straight 10.1 through all the strikes, and we find the 25 delta call. And we say, well, what's the implied volatility of that call? Whatever it is, it could be 9.5, let's say. Well, that's below, right? That's below that at the money. So how far below? Well, it's 6.7% below. So now we kind of get a sense by just without looking at all the strikes, without looking at the graph, we get a sense here that yes, the way the skew looks like it's sloping higher as the strikes go higher, sloping lower as the strikes go lower from the at the money. Okay, so when we click on it, we could kind of come down and see this graphically, right? So the 582, I think this is where the at the money was. So we could see that the implied volatility is moving higher as you go down in strikes, and it's moving lower as you go up in strikes. But there are two lines here, okay? So one of them, and this is important, so one of the lines, the ones with the dots, that shows the most recent implied volatility. Okay, that's what the implied volatility is by strike, the most recent. The line that doesn't have the dots, just the straight gray line, that was the day before. So what this allows us to do is see how that skew shifted on the day. So we're comparing exactly the strikes versus strikes. And now, not only do we see what the implied volatility is, the skew, but we also see how it changed on the day from the previous day. Just like we're talking about, we see what the value of the stock is, 582.30, but how did it change on the day, right? Up 0.4%. So that's what this is showing us now. Graphically, we're seeing that, wait a minute, here it looks like once we start going down these strikes, right, starting like around 576 strike, those implied volatility shifted higher on those strikes. That's what happened yesterday. Those went up, right? Those are the green dots that's telling us that's the distance you could see. Then the 582, right around that, the money was down. That's what the red dot's telling us. You could see. So it was down maybe, starting like around 577, going all the way up. Those shifted lower. So the implied vols went lower, starting, around the I would say 79 strikes and going higher, but then they shifted higher. So that's how that implied volatility skew within the month looked like yesterday, right? And we could expand it. So this here lets you expand the graph, but it basically looks at the strikes with some meaningful delta. As you go out further and further, those other ones become tails. So it tries to concentrate on that. We also see within this October 18th expiration, we see what type of trading activity was in these single leg options. Remember, this whole report is single leg options. And we see starting at around 582 strike and going higher. There's trading, it was mostly calls. That's what this yellow bar indicates. The 580 strike to me, just eyeballing was probably, looks even between calls and puts. And then as you go lower and lower in strike, mostly it's put trading. The strike that had the most trading volume with single leg options was the 580 strike in this expiration. Okay, and then you could see like maybe clustered between really 580 and 585, where looks to me like those were the biggest traded options. Then you got one like out here, but this one kind of stands out because there wasn't a lot of clustering of activity around the strike, just the 570 strike, maybe something happened. So really quickly, what we see here graphically, visually, is the distribution of the trading volume and the calls and puts single legs in the October 18th expiration that we selected, and how the option values were impacted on a relative basis when we use the implied volatility of those options. All right. That's just clicking on there. And here, if we just wanted to, and by the way, this also allows you to just kind of compare eyeball by expiration. You could see as you go out further in time, the skew gets it gets more steepens, right? Like where there's a bigger skew as you go out further in time. So the implied volatility goes up, and so does the skew. And it looks like as you get closer and closer, it kind of flattens. Right? So it starts to flatten. That's what it looks like. That as you get closer to expiration, it starts to flatten, and the implied volatilities from that, the money come in. So what about if we just, instead of opening up each of these graphs, right, to look at that, sometimes just a benchmark, a number helps us, right, to get an idea. Well, what does the skew look like? And that's what we're seeing here. And what was the change, right? So now we see kind of where the money is, what the skew looks like, and what about the change? Again, when we're dealing with options, those are different. You got different expirations, different strikes, but this is what this implied volatility change by strike means. What it's saying is that this particular at the money strike, if we compared it to the same strike, so there's two different ways you could compare it. You could compare yesterday's at the money to today's at the money. But if the stock moved, you're looking at two different strikes, right? So if the stock went up, if the stock's up $2.50, let's say the stock previous day was 580 and today it's 582.5. Well, now you have two different at the monies. You have the 580 strike and the 582.5 strike. So you're comparing yesterday's at the money to today's at the money. Another way to compare it is just look at today's at the money strike. Let's say it's 582.5. And say, well, what's the implied volatility today of this strike versus what the implied volatility of the same strike was yesterday? Right. So you're looking at 582.5 today. And what was it? And what was the 582.5 yesterday? No matter where the stock was, what was that strike, yesterday? That's what this is doing. So this is looking at strike versus strike over here. Okay. High volatility change by strike, and saying that if we looked at the same strike, we looked at today's at the money and looked at that same strike yesterday, this is how much the implied volatility changed. So you could see like just, the first 10, they're all lower. October 17th down 9%, October 18th down 6%, October down 2%. So that's what this is saying. So now we have an idea, just the same strike. How much did it change by? So similarly, what about the skew? We could look at the same strike. We see the skew. This is the skew of the 25 delta put, 25 delta call. But what was it? What was the change? What was it? Because the skew, did it remain the same, or did it change? Like, are the puts now even though they were skewed higher yesterday? Did they go up from yesterday to today, or did they go down? Because they could still be skewed higher, but how did it change? And that's what this is looking at, the change of that 25 delta put strike and the change of the 25 delta call strike. So here you could see that some of these, October 18th, 22nd, that even though we have a skew to the put, that increased a little bit yesterday. The skew to the calls decreased. So it got even they're already skewed lower, and then they even went even more lower than the previous day. That's what this is saying. Which in this graph we could see, right, that the slope of the line, on the downside was going lower, but now it even steepened even more low. Okay, so that's the looking at the change of, so what do we cover? We looked at really quickly now graphically, right? How much information do we get? We looked at the different expirations. We could see how the term structures lined up. It's upward sloping. We could see the implied volatility skew within each expiration relative to the 25 delta calls and puts. And we could see how much that skew and at the money IV changed on both the at the monies and those 25 delta puts and calls on the day. And we got all that information like from this one table. So this way you're not going to that options chain and trying to figure all that out. It's all kind of right here and in the table. And also think of it this, not only can you compare this, what this is showing us is not only can we compare this within the expiration or relative to other expirations, we could compare these expirations to how similar expirations behaved in other stocks or securities, like, well, did the same thing happen in QQQ? How's this skew in QQQ look like? Which is the NASDAQ or the IWM or, Apple. And did that the monies go down in those on the similar expiration? So this allows you to really start making relative comparisons across the board. So we're right up at 9:30. I'm going to stop right there.
Yeah, that was an awesome job, D. Thanks so much. Very good information as always. Thanks everyone for joining. You have
Thanks,
a great
everyone.
trading day and a great day in general. We'll see you guys tomorrow. All right, D.